Thanks for viewing our presentation. Today we're going to talk to you about the business strategy game and our company, Acme Footwear. This is the management team here. My name is Nicole Rogers.
Eddie Ranjman.
Ray Cradell.
Nancy Ramirez.
Today we're going to cover executive summary, segmentation strategy, overall approach, market dynamics, and at the end we're going to exit the strategy and company E legacy. And then our vision and mission in company is, our vision is to become the global leader in branded athletic footwear by focusing on delivering consumer value, innovative style and variety of offering. Our mission is to offer consumers a wide variety of branded athletic footwear at a great price and value through numerous global retailers and the internet. I'm going to start the question at Ray. Ray, we have heard the high-level vision and mission statement. What can you tell us about the strategy approach and whether it was successful?
Well, Eddie, our strategic approach started with a clear focus on market segmentation. We looked at the internet market, the wholesale market, and the private label market, and had a specific strategy in each. We were going to dominate the internet market, secure more than our fair share of the wholesale market, and at least our fair share of the private label market as we focus on maxing out capacity. Underlying that segmentation strategy was a clear focus on building highly efficient production, higher than average quality of product, as well as a very broad product offering, and where our focus would be staying ahead of the market in each of these key areas. The last key element of the strategy was staying flexible. We had an underlying strategy, but we knew we wanted to stay abreast of the market as well as the competition throughout the 10-year span of the business and continue to stay ahead of the competition. In order to do this, we had some clear methods that we focused on. To start, we wanted to build market share early. Again, staying ahead of the competition and locking up the customer base. While we were doing that, we wanted to build a foundation for the future for profitable growth and invest in the right areas to make that happen. And then lastly, use that to transition to a higher margin business model moving forward. So we invested in efficiency. We took on debt early in the business. We invested in the right plant upgrades, and we invested in best practices, all to take our costs down over time. And we invested in the market because anticipating a shift toward a margin focus in later years, we knew we needed to develop strong customer base, strong retail base, and strong celebrity support in order for us to leverage that strategy.
Interesting strategy. How did it work?
Well, it worked great, Eddie. Some of the results that we saw were the investment in efficiency definitely paid off. Our costs came down over time. Even over the last 3 years, as we expanded into a much broader product line and saw the increased costs of doing that, our overall costs per pair came down 7% during that time, so definitely paid off. Investing in the market paid off as well. As our costs continued to come down over the later years in the business, we were able to ramp our price up significantly and expand margins during that time. So definitely right on with our strategy. The flexible strategic approach paid off as well. So whether we were looking at the Chinese copycat companies that you'll hear more about, or the other competitors in the business, we were able to see what they were doing and adjust our strategy to stay ahead of the market each and every year. The payoff was in the key performance metrics that we looked at, whether it was earnings per share, return on equity, stock price. We had industry-leading numbers in all of these areas, and we'll talk to you a little more about that detail. And lastly, of course, we finished the 10-year competition tied for first place worldwide. So clearly strong strategy and good execution, and you'll hear more about that.
Thanks. Looks here like your price versus cost approach changed significantly over time. Was this part of your plan from the beginning?
It was. I had mentioned kind of a two-part strategy with a focus in the early years on growing the market share and locking up that foundation with customer base and retail outlets. So you can see that on the left side of the chart here, as the pricing costs kind of travel in parallel, and even prices declining as our cost is increasing. So there was a real focus in those early years on grabbing that market share. As soon as we had that locked up and we felt like we had the basis that we need for growth, we shifted over to margin. You see that changing. You see that changing as the price is increasing and the cost is decreasing, and that dramatic change is really what delivered huge margins in the final years.
Thank you. And your market share appears to be declining in years 17 through 20. And did this concern your executive team?
Not really. We would have liked to have seen increasing market shares each and every year, of course, but knowing that we were going to be shifting toward higher margin, we were able to tolerate some decline in market share in exchange for a dramatic increase in margins. So the huge increase in margin and operating profit per pair over the last 3 years more than compensated for any change in market share.
This chart shows an extremely close correlation between operating profit per pair and a stock price. Was this key lever to drive a stock price to such high levels?
It was a key lever. Of course, our focus throughout the competition was to drive higher shareholder value and the highest stock price possible. So there were several levers that we looked at. One throughout the business was an opportunistic approach to stock buybacks. There were a couple of times where we saw the stock price dip below what we thought was a normal level, and we took the opportunity to buy back a significant number and reduce the number of shares outstanding. We looked at simple things like debt reduction and debt refinancing to take our costs down, and continuing to increase dividends to drive shareholder value. But you can see here in the chart that the foundation of the growth in share price is almost exactly correlated with our operating profit per pair. So the payoff from improved efficiencies clearly translated year after year into increased stock price and increased shareholder value.
Thank you, Ray. Welcome back. Nancy, Ray showed us an overview of Acme Footwear performance. Can you explain what the company's general approach was?
Sure. So here's our overall approach when we first took over Company C, which is Acme Footwear. We did these 3 key things that were important for us. We wanted to be the low-cost provider of high-quality footwear, and to accomplish that, we were looking into balancing superior material with standard material there. Then we also wanted to be lead industries in the leader in the industry of compliance and distribution efficiencies. And to accomplish that, we knew that we had to invest in key upgrades for our plants and also invest into best practices training. Last approach we took was to increase our retail outlets in each region, and to do that, we knew we had to provide retail support or increase retail support once we started going into each region.
And
so we also knew that there was 3 segments for each region, and each region had an internet, wholesale, and private label. Now, when we first started managing Company C, or Acme Footwear, we knew we wanted to dominate in the internet segment for all regions. We kind of wanted to monopolize it. Then in wholesale, we did want to have a strong market presence. And for private label, we wanted to be there, win some bids there, so that we can spread the cost of producing these shoes.
thank you. What were the results of your initial strategy? Did it work?
Actually, it did, Eddie. If you can see at the numbers here, we increased our EPS, we increased the ROE for the company, and that stock price looks pretty good. $24 increase there. And you can see that we were facing some key competitors there, but we still managed to have great results from that initial strategy. We knew we had to work something out with the North American plant because we see that all these competitors were surrounding our company. We're right here, the one pointing with the arrow, and we were looking forward to modifying just a bit just because the initial strategy did work out.
Thank you. Later new factors appeared in the market, the German company and inflation. How did you modify your initial strategy?
Well, these were very challenging factors in the market. We did take 3 key actions here. We did control our spending, so we started reallocating our retail support for each region, and we also purchased additional capacity at that time. That was more in the Asia Pacific region because we did see demand increasing, and we also wanted to operate in max capacity. So with the new capacity added to our Asia Pacific region, we wanted to make sure we use that as well so that we could reduce the cost.
Thank you.
So then this is the results of those actions we took. We did struggle a bit there, and the reason why we were struggling there is because we did do all those three actions where we were controlling spending there for a moment and reallocating the retail support. And in some markets, we did see a decline of our market share. In Asia Pacific, as you can see by this picture, we were closely competing with other companies, and our strategy was similar to other ones. So we knew that in Asia Pacific, we needed to differentiate our strategy.
Looking back to years 11 to 14, we see fluctuation of the numbers. Can you explain what happened in year 14?
Yeah, so as you can see with this from year 11 to 14, yes, the fluctuations is kind of drastic there. Year 14, we did see that some of our key numbers decrease there, and the reason of that being it's what I mentioned before. We did try to do many things at the same time, such as upgrading a plant, and we also purchased capacity, and we also started a new plant in Europe, as you might recall. So that was a financial strain on our company, and that's why you see our credit rating declining as well, and so our ROE declining. But overall, though, our market share still remained competitive.
Nancy just walked us through the great strategy Acme Footwear followed to defend against German companies. Nicole, what are some other challenges the company faced, and what new or different strategy took place?
Well, as Nancy has mentioned, we did have the challenges of the German companies, but what was more challenging was taking on a new company, which is Company E, which we've deemed Acme Footwear 2. At the end of year 14, the management company was transferred over to Company E. This new business unit we took over. As some of the actions that we took right away is we knew we had to do a company assessment. We had to look at the strengths and weaknesses, come up with a strategy from there. We learned that quickly we had to do some damage control in the first year, and then the years to follow, we came up with a strategy to focus on future growth.